So I want to just sort of remind everybody again how the last banking crisis played out, because I believe there's going to be another one probably before the elections, probably pretty darn soon. And I believe that it's really, really, really time to hold gold and silver. Welcome to this video. On June 3rd, the New York Stock Exchange experienced a volatility glitch, and it affected dozens of stocks, many of these very, very large stocks. So what happened? Multiple New York Stock Exchange stocks now have been halted on volatility due to a technical issue. Berkshire Hathaway, that's Warren Buffett. The A shares, his stock, is currently down 99.97%. That means that it plunged to only 0.03% of its value earlier. Did GameStop just break the market? Moving on. This is a chart of Berkshire Hathaway, and you can see that it was trading at $627,000 a share. That's the A shares, and it crashed all the way to $185 a share. Unbelievable. So the trading was halted. I went and made a longer term chart going all the way back to the inception of Berkshire Hathaway. So this is when they were first publicly traded. And you can see the plunge here, and then when it came back, it bounced up also. So this is just the symptom of an extremely fragile, unstable financial system pyramided on top of an extremely fragile, unstable monetary system. And we're going to see things like this increasingly. So, monetary policy decisions. This is June 6th. European Central Bank. We cut our interest rates by 25 basis points. 0.25 percentage points. Keeping interest rates high and making you suffer for 9 months has helped push down the inflation that we caused through all the currency creation when we overreacted to the pandemic. It's now appropriate to moderate the degree of monetary policy restriction because it might be popping a bubble that we created. And so we need to blow some air back into that bubble, so just in case it starts to deflate and the deflation turns into an implosion. So that's the full quote from them, including reading between the lines. Just in, Denmark cuts its rates by 25 basis points, following rate cuts by Canada and the EU. So you just saw the European Union. Now, this is interesting. I just ran across this recently, and so Darth Powell posted this. Medium household incomes are collapsing like we're in a recession. But I bookmark and collect series of charts that are early warnings of a recession happening. And this is an amazing chart with a 100% record here, but only going back into I wish it had the double dip recession of the 80s, and I wish this went back to like the 60s, like a lot of other indicators do. But what you see is this is annual data. So each one of these data points is a year, and so this has accurately predicted that a recession is coming more than a year before the recession gets here. And except this has been going down since 2019. So we should be due for one hell of a recession. So a restaurant apocalypse is starting to sweep across America, and that is really bad news for the U.S. economy. You can get a really good idea of how the U.S. economy is doing by watching restaurants in your area. And it was about 6 months or more ago, maybe 9 months ago, I noticed that the restaurants here in San Juan during the week were not doing very well. And this is during a time of year when they should have been doing well. So midweek, they were pretty darn empty. And now I'm noticing this effect on weekends as well, when they should be extremely busy. Americans under the age of 40 love to eat out, but these days most of them are experiencing financial stress, and this is having an enormous impact on the restaurant industry. So this is your own indicator of where the economy is going. What's happening in the restaurants that you go to? And when you're driving down the street, just take a look during dinner hour. Are they as full as they used to be? Market crash indicator with spotty track record, the Hindenburg omen, was triggered last week, and this was the end of last month. So, what is the Hindenburg omen? The Hindenburg omen is made up of tracking. It compares the percentage of new 52-week highs and new 52-week lows in the stock market. And then on top of that, the FDIC is warning that 63 lenders are on the brink of insolvency due to banks sitting on $517 billion in unrealized losses. And that is big, but this is something that I've been tracking for a long time. This chart updates that $517 billion of losses that they're sitting on, and it's being driven higher by residential mortgage-backed securities. So I first showed this chart. This is FDIC info. That's where the source is. And when I showed that video, I actually took you to the FDIC's website and pointed out what was happening. But when I first showed this during the collapse of Silicon Valley Bank in March of 2023. So this bar was not yet here. So all these bars have been added, but you can see the banks are in trouble. They've been in trouble for some time. How the Federal Reserve and the Treasury are holding this thing together with both hands, I do not know. This is some. They're slapping. There's a hole appearing in the balloons, these bubbles, and they slap Band-Aids on it to keep it from popping, and then blow more air in by lowering interest rates, which is what they're doing now. So we're in this very precarious position, but this is residential, as it says right there, residential. This doesn't take into account as much all of the mortgages for commercial real estate. So this is securities, which is mortgage-backed securities, and the treasuries that banks use as they use that as a currency between them for settlement and stuff. So what you've got here is the gold bars are ones that are available for sale. When they're for sale, they've been marked to market. So it's whatever they are currently worth is what these gold bars are reporting. The blue bars here are securities held to maturity. So they're in that category where they get to value them at what they were worth basically when they bought them. They don't have to mark them to market. They're carrying this enormous lie on the books to make things look better than they really are. So I want to just sort of remind everybody again how the last banking crisis played out, because I believe there's going to be another one probably before the elections, probably pretty darn soon. And I believe that it's really, really, really time to hold gold and silver. But and I do. But March 10th, Silicon Valley Bank collapses after a run on deposits. Signature Bank saw a torrent of deposits leaving after customers began panicking. New York regulators shut down Signature Bank. This is the 12th. Signature Bank over concerns that keeping the bank open could threaten the stability of the financial system. But coincidentally, Signature was one of the few banks that opened its doors to cryptocurrency deposits. So could there have been like an ulterior motive for shutting the bank down? And moving on, March 13th, so this is the next day, regional banks stocks plunge after unexpected seizure of Silicon Valley Bank and Signature Bank, with shares of First Republic tumbling 60%. And then 11 of the largest banks injected $30 billion into First Republic, which was teetering on collapse. March 19th, UBS, Switzerland's second largest bank, agreed to buy its smaller rival Credit Suisse for $3.2 billion. Now, Credit Suisse had assets, deposits are a liability. They had deposits of $1.7 trillion. And this bank was purchased for $3.2 billion, and the Swiss National Bank agreed to lend up to $100 billion billion Swiss francs to UBS to help close the deal. So this is how far underwater the $1.7 trillion on their balance sheet, it was upside down by $100 billion, and so they bought it for just 3 points. So this was really big, and the FDIC entered into agreement to sell 40 of the former Signature Bank branches to New York Community Bancorp, who we know later had a few problems. First Citizens Bank shares agreed to acquire Silicon Valley Bank in a government-backed deal, always government-backed, so basically when it's government-backed, we're on the hook. That included purchase of about $72 billion in loans at a discount of $16.5 billion. It also included the transfer of all of the bank's deposits, which were worth $56 billion. And this is all copy-pasted out of other articles. First Republic was taken over by the FDIC and immediately sold to J.P. Morgan Chase, making it the second largest U.S. bank by assets to collapse after Washington Mutual in 2008. And I want to remind you that the FDIC right now is warning that 63 lenders are on the brink of insolvency due to banks sitting on $517 billion of unrealized losses. So, and then, a savings app. This is the instability of the financial system. A savings app CEO says 85,000 accounts were locked in a fintech meltdown. We never imagined a scenario like this. So 85,000 customers with combined deposits of $112 million in savings were locked out of their accounts. And the disruption is caused by a dispute between financial technology middlemen. So people probably doing the build of this app or this website. And there's a dispute going on, and they were able to just lock everybody else. We never imagined a scenario like this could play out and that no regulator would step in to help. And I want to thank my friend Lobo Tigre for this. This can't happen to my stacks of gold and silver bullion. And that is absolutely true. And I want to remind everybody that the mission of this channel is to enlighten the world that maximum prosperity can only be achieved through individual freedom, free markets, and sound money. And that is a fact. I want to thank you for watching. We'll see you next time.